Hi, I'm Benjamin Thomas Solomon. I am running for California Congressional District 16, which includes parts of San Mateo County and parts of Santa Clara County. In this short presentation, I will talk about quantitative easing, inflation, and HELSIS. It is a bank product that I invented, which will reduce mortgage defaults by up to 70% and therefore reduce bank risk capital requirements by a similar amount. Okay, let's start with quantitative easing. What is quantitative easing? Quantitative easing is a monetary policy strategy to stimulate the economic activity during a financial crisis to keep credit flowing. And how it's done is central banks purchase securities to increase the supply of money, reduce interest rates, and drive more lending to consumers and businesses. And this is a summary of the data that is derived from Congressional Budget Office, and I'll show you in the next slide. Okay, this is the sensitivity analysis using the CBO's 2020 July 2020 forecast. There wasn't a later one as of this recording, and you can see that the graphs, this is the public debt held, which is basically the difference between, it's a federal deficit, it's the difference between the tax received by the federal government less the spending of the federal government. And when you have this deficit, it's because the receipts are much less than the spending. So when you put it into perspective in terms of GDP, then you get to understand the size of the deficit. Right now, it's at just over 100% of GDP. It's quite big, considering that prior to 2008, our deficit was in the 50 to 20% of GDP. And now, effectively, congressional decision basically changed the way we operate. We are now operating in an economic environment that's 100% of GDP. CBO's forecast of public debt is in the 100% range. They forecast it'll be about 108% of GDP by 2030. And the CBO's forecast of interest rates will be between just under 2% to just above 2%, almost 3%. And when you do the sensitivity analysis, you are looking at worst case because you want to know what can go wrong. And there are two worst case here. A good worst case, which is based on 0.38% interest rate increase a year, and a bad worst case, which is based on 0.75% increase in interest rates a year. And these are based on historical numbers, because if you look at the increase in the interest rates over the whole entire time period from 1970 to 2020, it averages around 0.38%. If you just look at this region, the interest rates averages at 0.75% here. So that's this graph. So when you combine the two together, you can now work out the impact of net interest income, net interest on debt in the federal budget based on these two scenarios. And it's for another video, but it's not good. And it's primarily that downside risk substantial downside risk is because our quantitative easing has pushed up our public debt to a remarkably large amount. Now let's look at the next slide. All right, so we are interested in the impact of interest rates due to quantitative easing, and those are based on models. So we want to know, are these models good in the current regime, 100% of GDP regime? Okay, I plotted two sets of data. This data is available from the Federal Reserve Economic Data, FRED, that is hosted by Missouri St. Louis Federal Reserve. Okay, on this side we have the velocity of money, and on the x-axis we have public debt as a percentage of GDP. And you can see that prior to 2008, velocity of money was operating in the 1.6 to 2.3 range, and the GDP was public debt was below 60% of below 70% of GDP. So that was the original operating region, and you can say that most of our econometric models were built based on this original data. And then as quantitative easing came into the picture, you can see that the velocity of money continued to drop. You can see quantitative easing increasing the public debt as a percentage of GDP, and it's making the transition to this new region. So there are two regions. There is a new operating region, and there's the original operating region, and there's this transition period. So the big question is, are our econometric models still valid in a substantially different public debt environment? My guess, as somebody who has worked with data for the last 40 years, built a lot of different models in infectious disease spread, in credit risk, in financial modeling, and also in economic data. I built models of 3-month treasury rates based on M3, which the government no longer publishes. And my guess is that in this new region, I would be very careful about saying that the models are still valid. Okay, and then I plotted inflation against a velocity of money. And what we see is that there are three regions of behavior. Down here is the original low inflation operating region. This is the data that's telling me what's going on, and not the econometric models that's telling me what's going on. So this data basically says, these points here basically says that you can divide this information into three regions. The low inflation region, which is here, up to about 4%. And then there is an abnormal region here, which is the high inflation region, which can go up to about 15%, which did happen during Reagan's time. And he brought that inflation down with some really tough economic medicine. And then today we are now in this region. So because the velocity of money has slowed down. Velocity of money basically says how many times is a dollar used uh, to transact. And when it's two, a dollar is used two times in a transaction. When it's here, it's only used once. Why? Because the supply of the money is so large that you don't get the chance to see the same dollar come back a second time. So my conclusion, looking at this, not as an econometrist, but as somebody who has worked with tons of data in many different fields, I would say that there are three different operating characteristics uh, in our economy. And if you use a model that's here, it will not give you the right answers here. If you use a model that's up here, it will not give you the right answers here. And neither of these two models will give you the right answers in this region. What this tells me is that there are some factors in here that are dormant, and then when it kicks in, it becomes a high inflation environment. That's why the Fed said a few days ago that modeling inflation is not so easy. Yes, it's not so easy if you haven't done this. Okay, what is HELSIS? This is a bank product that I invented last year. Because of the lockdowns, there are a lot of things we could not do in 2020. Because of the lockdowns, there are a lot of things we could not do. And so I went back and looked at my credit risk experience, and I published two monographs. Monographs are thin volumes on a very specialized topic. One is a critique of Dodd-Frank. The other is real-world data modeling. I do not use the term data analysis because data analysis is a field of computer science. It's maybe 5 or 10% statistics, whereas data modeling is a field, should be a field of statistics with maybe 5% or 10% of computer science in it. With data modeling, you are concerned about why things are happening and not trying to forecast what will happen. Because if you have figured out what's going on, then you will be able to build a better forecast. So HELSIS, it's a HELOC reverse mortgage combination. It stands for Home Equity Line for Self-Insured Servicing. It's a temporary source of cash or a bridge to maintain the borrower's contractual debt service requirement when the borrower experiences temporary reduction in income. And this is most often in a recession. The borrower loses his job, doesn't have the income to make those payments. HELSIS comes in and the borrower says, "Hey, bank, I signed up for HELSIS. I'm going to be delinquent, or I'm delinquent. Activate HELSIS." And HELSIS makes the contractual payments until he or she, the borrower, is recovered and can um, restart making the payments, and also make the payments to clear the HELSIS account. It's guaranteed because it's a HELOC reverse mortgage. It's guaranteed by the excess collateral in the property. Mortgages are almost always, usually 80% LTVs. That 20% is unutilized, so we take a slice of that unutilized collateral, anywhere between 2 and 10%, and set it up as a HELSIS. Primarily because what I've observed is that most mortgage regulation was formed in good times and do not adapt well for bad times. And the obvious thing is that we have forbearance. There is no need for forbearance if we have HELSIS. And forbearance basically says that the government is providing help to its people when the market can do it. It makes politicians look good that they're helping the people. No, if we had put the right systems in place, for example, HELSIS is one of them, that would not be necessary. Okay, so let's look at this. This is the collateral value of the property. For reverse mortgage, there are several conditions. The age of the borrower must be more than 62. The current mortgage LTV must be less than 50%, and the amount less than 765,600. So there are these restrictions on the reverse mortgage. So this is a drawback. We need Congress to tweak the reverse mortgage requirements so that we get for HELSIS, so that we can use it when the borrower does not have sufficient income and is less than 62 years old, and usually will have an LTV much greater than 50%. So HELSIS cannot have these disqualifications. The reverse mortgage portion of HELSIS has to be adjusted so that we can use it for everybody. Okay, I did some preliminary calculations. If you have HELSIS, this is for a typical loan, a California residential home mortgage. Typical California home price at 800,000, down payment 160,000. Average interest rate was about 3.19%, and I said, okay, for a HELSIS, if it's activated, let's put 0.5% more. LTV is 80%. That gives a loan of 640,000 over 30 years. And let's treat the HELSIS as a regular fixed rate mortgage, and let's say it's 7 years. Well, the front end debt to income ratio is 29.5%. Monthly payment is 2,765. So if we have a HELSIS of 6 months, 12 months, 18 and 24 months, this is the amount of the HELSIS capacity to restore the delinquent borrower's payments. And the suggested monthly repayment as a percentage of the loan of the original property, it's between 2.5 and 11%. And this is a suggested monthly payment. And the upper limit of the front-end debt to income ratio jumps up, increases very marginally from 29% to about 31%, 32%. And it's quite a little bit more. At 24 months, it's about 39%. But this is to illustrate, because in actual fact, the HELSIS would be a HELOC. And so you see that from a debt to income perspective, HELSIS is workable. Okay, and this is my analysis. You can see that the source of this figure is from my monograph, A Critique of Dodd-Frank, Forecasting Securitized Mortgage Credit and Default Risk. And there are three important pieces. This is a standard default function, borrower's default function that we see in the literature. It peaks at year 4. What is very different is that I have figured out that it is derived from two other functions. One is the sustainable cash flow line, which is this line here, and the other one is the lender's default function. Okay, it's 100% after year 4. So when you multiply the lender's default function with the sustainable cash flow line, you get this borrower's default function. And this is what you see in industry. Industry calls this portion seasoning. I have an alternative view. Basically says that with this specific data, 2.89% of the borrowers were approved underwriting. This HELSIS does not mean that we can do away with underwriting. It is a must. Even with underwriting, 2.89% of borrowers who come in have problems with their sustainable cash flow, but they are able to cure. That's why we do not see them as defaulters. We see them as defaulters up at this region. And everybody above that line are borrowers who are able to cure their loans. But once you reach year 4, those borrowers who are delinquent do not have the capacity to cure their loans. And so what is required is HELSIS. They need more time. They do not have the capacity to cure their loans within 90 days. So what we do, if you've lost a job during a recession, you know you're not going to get it in 90 days. It's going to take 9 months, 1 year, 1.5 years to get an equivalent job. So what we do is we use HELSIS as a bridge between the original income situation to the subsequent income situation where the borrower can continue paying. Alternatively, what HELSIS does, everybody below this line in this region are defaulters. Everybody above this line are prepayers. So the defaulting population and prepaying population are two distinct populations. You cannot build models where you combine the two. But academia does, so be very, very careful what you read. So what HELSIS does is if the borrower cannot recover in time, it gives him the opportunity to migrate to a prepayer by selling his property before he defaults. And the proceeds of the sales will be used first to pay off the original mortgage and second to pay off the outstanding HELSIS. You can say that price of the property collateral would have dropped. Yes, in the Great Recession, property prices dropped. I believe it was March of 2009. Property prices dropped to, or 2010, dropped to 55%, but it shot back up after that to about 75% or 80%, somewhere around there. It eventually reached its original value a couple of years after that. So yes, if you're a long-term buyer and you're holding on to your property, HELSIS is a perfect solution. If you are an investor and you want to hold on to your property, okay. But if you are an investor and you're going to sell the property because its property value has dropped, well, that's something that nobody can help you with. But the vast majority of homeowners live in their properties. It's their home. They have bought it to stay put. They do not want to lose their homes to foreclosures. And the point behind HELSIS is to provide temporary cash flow within the existing legal and regulatory framework. And by recognizing that defaults or delinquencies are due to temporary unsustainable cash flow, triggered, usually almost always triggered by recessions. Okay, there are cases where it's due to medical bills, um, are humongous, but that's a different problem to solve. And so from these calculations, based on the CMBS data that I had from the 1990s, HELSIS for 6 months period can recover 4.2 to 17.6% of the defaulters. In For a 24-month period, it's between 70 to 53%. In residential mortgage, it can be as high as 70%. Okay, that's the next most important property of houses is it's a distributed wall of money. Timothy Gardner and Ben Bernanke came up with and implemented the wall of money that stopped the financial meltdown in 2008, 2009. And it's basically one giant wall. What we are doing with HELSIS is now we are breaking it up into individual bricks that are distributed, and each brick will contribute to the wall. It only gets activated when the borrower gets delinquent. So the banks are safe. Okay, that's it. My presentation for HELSIS. I hope that you will vote for me, Benjamin Thomas Solomon. I am standing for Congressional District 16 in the coming midterms. June 2022 is the next one, and you can see more information about who I am at Solomon number 4 congress.us. And if you'd like to contribute or donate to my campaign finance, you are welcome.